Welcome back to the portfolio, everyone. And in this video, we're going over 7 stocks you should keep your eye on this week. All 7 of these companies have some major news headlines coming out over the next coming days. We have some earnings reports, some new product launches, and even a big event that may lead share price growth. So what we're going to do in this video is go over each company, discuss why we have to take a look at them over the next upcoming week, and discuss if we're going to jump in and buy them at their current share price. So we're going to go over 7 different stocks from various sectors of the market that operate all around the world and bring in revenue in various different streams. As you may know, I am the Gen Z investor, and every single day we make videos about the stock market. We go over different stocks you can buy, and we talk about any big stock market news or headlines. So please like and subscribe for daily videos about the market, and we're going to jump right into the first stock on this list. Tesla is the first company you should keep your eye on this week. The share price has been surging. It is up over 800% over the past year, but as of late, we've actually seen a big decline in share price. We saw a peak at around $500, and shares all the way brought back and dropped to $330 a share. Over the past few days, we have seen somewhat of a recovery, and that is because big anticipation for Tesla's big event this week, which is Battery Day. So this is where the company talks about all their future plans, their growth potentials. Elon Musk goes over some very innovative products and services that really help boost investor confidence and may help the share price grow not only over the short term, but over the long term as well. This is where Tesla can announce various new products, Elon can get as innovative as possible, and just share all his big expectations for the company moving forward. So this is a big company to take a look at this week. I believe the share price may see a massive jump if Elon Musk can come out and share some positive news about the company and a lot of earning potential growth over the next 3 to 5 years. So overall, we know Tesla, they have reached all the requirements to be potentially added to the S&P 500. We saw that when they were announced that they were not added to the S&P from the last quarter revamp, the share price declined. But overall, very interesting company to keep your eye on over the next coming week, especially with Battery Day coming up within the next few days. The second stock this week to keep your eye on is Apple. They are up 91% over the past 12 months, but their share price over the past month has been on a massive decline. You can see here shares peaked at around $134 a share, and we have seen a steady decline of over 15% back down to $106. On the 52-week range, Apple, who was breaking new all-time highs every single day about a month ago, has seen a massive pullback and is trading somewhere close to the middle on that 52-week range. So this Apple might be a beautiful buying opportunity this upcoming week because they have some massive news events. They are actually launching their first ever online store in India this upcoming week. So of course, India is a massive market for their products, and now they're actually launching their full Apple online store this upcoming week. They're going to offer a full range of products and services directly to the consumers all across the country, which is a big, big growth market for Apple. So Apple, of course, we know has been one of the largest companies in the world for a very long period of time. They did cross that $2 trillion market cap valuation, but have since seen this massive pullback, and their valuation is trading back down to $1.83 trillion. They are a dividend-paying stock. Their current yield is 0.77%, which is extremely low, 25% payout ratio, which is extremely sustainable, and they do a beautiful job of growing that dividend by at least 10% per year over the past 5 years, and their dividend safety score is the highest possible, coming in at 99, so this is a beautiful dividend growth stock to take a look at this year and over the next few days. The third stock to keep your eye on this week is Nike. This consumer brand has been on fire. Although they've had to shut down a lot of their physical retail locations, their digital and direct-to-consumer marketing plan has been phenomenal. Their online direct-to-consumer business has extremely high margins, and this company, although we're going through an economic shutdown, is still raking in cash. So in this week, we have Nike's earnings report coming out on Tuesday. So this week is a big day for Nike because we're expected some nice, beautiful growth, and we believe this company may beat expectations due to their online digital presence. So this is a company we're keeping our eye on this week because of their earnings. Over the past 1 year, shares are up over 30%. Over a longer term perspective, shares are up close to 100% over the past 5 years. This is another dividend company yielding 0.85%, a sustainable payout ratio just shy of 40% of earnings, and they've done a nice job of growing that dividend at over 12% average over the past 5 years. If we jump in and take a look at how safe their dividend is, coming in at 99, which is the highest dividend safety score possible, so very unlikely that they see a dividend cut anytime soon. The remaining 4 stocks on this list all report earnings this week as well, which is why we should keep our eyes on them. Earnings reports lead to some nice share price volatility and may create nice buying opportunities or nice surges in share price. So the second company reporting earnings, and stock number 4 on our list today, is Costco. So this company has remained operational even throughout the pandemic. They were never forced to fully shut down all of their stores, and they continued to generate revenue and actually saw revenue surges during this time of slowdown. Currently being traded at $335 a share, they were up around 15% over the past year, and on a longer-term perspective, up 136% over the past 5 years. Market cap of $148 billion, this is a very large company who continues to grow and continues to operate very nicely. They have strong brand loyalty, and their earnings report this week will be very interesting because now they had some competition. Other grocery stores and consumer brand stores were remained open over the past few months, and this latest quarter will really determine how Costco could compete, and it will be very interesting to see how their online and digital sales performed. If we take a look, stock yielding 0.83%, payout ratio around 32% of earnings, and once again, a company that does a beautiful job of growing their dividend at a rate of 14.5% average over the past 5 years. And once again, the highest dividend safety score possible at 99, another company which is very unlikely to cut their dividend anytime soon. Moving on, stock number 5 on our list today is Accenture. Ticker symbol ACN, up 21% over the past 12 months. This company also reports earnings later on this week, and they have seen beautiful long-term growth of over 142% over the past 5 years. Similar market cap to Costco at $150 billion. This operates in the IT and consulting services company, and you can see here a 1.35% dividend with a payout ratio of around 41% and a slow dividend growth rate of only 3% average annual over the past 5 years. So this is another dividend growth stock. They continue to have nice share price appreciation tied in with a little bit of a lower yield, but over the long term, they continue to grow that dividend year over year. They have a 92 dividend safety score, which once again represents a very safe rating, making this a stock where it's very unlikely to see a dividend cut anytime soon. Stock number 6 on our list today, the consumer brand stock General Mills. Up only 5% over the past 12 months and up only 1% over the past 5 years, this share price really hasn't seen any movement over the past 5 years as well. 52-week range trading somewhere in the middle and a $35 billion market cap. This is a higher dividend yielding stock that also reports earnings this week, currently yielding 3.42%. They only have a payout ratio of around 55% of earnings, which is very sustainable, and they've grown their dividend on average of 4% over the past 5 years. Taking a look at their dividend safety score, coming in at 69, which is still considered safe, not the best dividend safety rating possible, but this is a slower growth company where if you believe in the brands that they own and you believe that they're here to stay over the long term, you may want to jump in at this 3.4% current yield, especially when they report earnings this week, which may lead to a jump or a decline in share price. Moving on, the final stock to take a look at this week is Cintas. $318 a share, currently up 27% over the past 12 months. Another company that's seen rapid growth, and over a long-term perspective, this stock has been on fire, up 268% over the past 5 years. This is another dividend growth stock with a lower starting yield, but decent dividend growth year over year. 0.8% starting yield, 31% payout ratio, and 24% average annual dividend growth, which is absolutely insane. They have a 97 dividend safety score, once again making this a stock which is very unlikely to cut that dividend anytime soon. So those were 7 stocks you can take a look at this week. Thank you for tuning in, everyone. And as you know, I'm the Gen Z investor, and we post videos on the stock market every single day on this channel. So please like, please subscribe, and I will see you in tomorrow's video.